All right, we've been watching a nice rebound yesterday as well as today, but of course the question for so many investors is whether or not this will be sustainable. Let's get the head of trading at Barometer Capital's take on that. That's Diana Avigdor joining us now from the TSX. Diana, you said during the commercial break, what do you want to discuss? The rally or the sell-off? I don't know. I mean, what do you want to focus on here? I mean, I guess the question is whether or not this somewhat melt up is sustainable. As I say that, it's fading a little bit right now.
Yeah. I think that is what's the past, but the real question is what's going forward. Look, there is in my opinion, there is a bit of a conflict. The fundamentals and the macroeconomic narrative is good. There has been a lot of technical damage in the market, and we have to respect that. A lot of volume has gone through the market in the last month. The selling was triggered by quantitative strategies, which if we have time, we can certainly discuss because they move the markets a lot. But going forward, as we watch this small rally, I think that you have to be mindful of the technicals. The volumes are very high today, or high today, not very, but high, and they were high yesterday as well. I think the fundamental narratives are still there, Catherine, and so people are fitting explanations, fundamental explanations onto a situation. But for example, on the earnings front, so people say, okay, the market sold off because we're at peak earnings, or earnings have not been good enough, but they've been okay. They've been fairly good, very good actually. So I'm finding that fitting a narrative onto the action is what's happening right now, and it's coming with a lag. That being said, the technicals have to be respected, and we respect those technicals, and we're going to have to see whether we're able to repair. So a wound gets repaired one cell at a time. So
let's just then talk about the technicals, because they have been a big driver for the market performance, for the price action. I had a technical strategist on earlier today over from Strategas, a very well-respected firm. They don't seem to be too convinced that, that these technicals are showing enough breadth as well as volume to get overly excited about as of yet. We still need to wait and see, to your point. But what specifically do you mean? It sounds as though you're in the exact same camp, which is maybe why we're seeing a bit of a fade here.
Yeah, very basic technicals, simplicity first. 200-day moving average, right now we're below it. We want to see indices getting there first of all, then doing the work that's necessary to hold above it, and then keep on moving up. Breadth indicators, I think that Strategas gentleman was talking about the fact that despite that we had a little bit of a one-day rally, which by the way, yesterday, twice in the day yesterday, we had a 1% sell-off. So it was a kind of a roller coaster day, but then it finally held. And the interesting thing is that at 2 o'clock when the market on close data came out, it was $1 billion for sale, which is large, and then it got absorbed, so it was a really good close. But despite that fact, the fact that it went up and down with such volatility, the breadth indicators have not supported it so much. And it requires more than 1.5 days of rally to correct the kind of carnage that we've seen in the month of October.
Tomorrow we've got Apple reporting. Friday we've got the U.S. jobs report. Next week we've got the FOMC. There's a lot of potential catalysts that could reset sentiment. Do you think that it will, and will it set it to the upside?
And that's a fantastic question. So in terms of Apple, I think that it depends where the market is. I think that if Apple reported let's say yesterday at the top of pessimism, no matter what they would have reported, it would have been okay. I think that if we rally another 2%, if guidance is not so great, I think it has the risk of being negatively impactful. That being said, we don't expect a negative report out of Apple, and Apple is a very important read to the technology chain and a very, very important read on China.
Diana, you invest in the United States as well as Canada. You've been more overweight to the U.S. Sectors versus Canada. But right now, when you take a look at some of the Canadian names, because we're starting to see reports here as well in terms of the earnings, the quarterly earnings reports, what's your assessment so far? What are you watching, and what do you care about?
So our asset allocation mix was about 70-80 U.S., 20 Canadian. We haven't changed that asset allocation mix. Some of our portfolios are sitting on 20-25% cash. So we're still in the same kind of weight. We are looking for growth, and some of the growth names can be found in the U.S., in the more diversified sector. sector separation, so a bigger healthcare, a bigger technology. I think people have been hiding in some of the credit card companies, but the financials might still be okay. Canadian financials are great dividend payers. I think that long term you do very well by holding on to some of those. But specifically to say, I really last time we spoke, I thought the energy trade would have done better. We talked about the stock market and I said we're bullish, but there are some signs of carefulness that we're watching. But I mentioned the energy sector. I'm kind of disappointed with how some of these names acted, but maybe that's a function of the whole market. If energy would start taking on leadership, it would be fantastic for the Canadian market.
Is there any leadership in the Canadian market right now?
It kind of ebbs and flows right now. Look, Canadian market year to date is down, I don't know, maybe about 7%, I think.
Yeah.
Right? It's not the worst market in the world. You look at European markets year to date, and you look at Asian markets year to date. So I know U.S. really was the place to hide. U.S. I think yesterday has overcome. It's become positive again for the year. So this is all a relative game. So Canada hasn't been the worst market to be in, really, if you're talking about relative strength. If you have to be somewhere, U.S. was okay. Canada was only down 7%. But if you avoided Europe and Asia, you're okay.
Yeah. All right, Dana, we'll leave it there. Good to see you. Thank you very much.
Thanks for having me.
Thanks. That's the head of trading at Barometer Capital, Dana Avigdor.